Hi, I'm Michael Sidgmore, co-founder and partner of Broadhaven Ventures and founder of the Alt Goes Mainstream podcast. I'm here today with Sonali Basak, Chief Investment Strategist at iCapital. Thank you for joining us for the iCapital 2026 Market Outlook. Before we dive in, just a quick housekeeping note. After our discussion, there will be a 10-minute Q&A session. Please feel free to submit your questions anytime during the webinar using the Q&A box on your Zoom screen, and we'll do our best to address your questions during the final 10 minutes. Let's start with the theme for this year's outlook, balancing divergences and blind spots. All right, there's a lot going on in the world. What's your take?
Yeah, the beginning of 2026, you saw how that played out from the geopolitics to the micro and the macro. When we think about divergences in particular, think about how many there are, and let's start just with growth and the labor market. The fact that we've seen growth hold up, but the labor market not really keep up with that growth. And then when we think about blind spots, you think about areas in the private markets like 2020 or 2021 vintages that are yet to materialize, or the AI trade, which is at a turning point where you're seeing a lot of dispersion forming in the markets. These are real blind spots, and we've been highlighting it since the end of last year because we believe that these blind spots will really create new narratives in these trades. Now, that has implications for public and private markets. For public markets, very easy to see how this is starting to play out this year, that there's clear uncertainty around who is going to be the winner in the AI trade, or the multiple winners when it comes to AI, when it comes to software, and then you feed through to private markets, and to the extent we keep seeing those uncertainties play out, can the capital markets stay wide open enough so that we get that exit pipeline that investors have been hoping for? Can we see that benefit of AI that a lot of investors have been hoping for feed through into private markets where in venture some of those valuations might be more attractive? Or is there too much money in the ground that's currently vulnerable? These are the things that will work their way out through 2026.
I think that's a great overview of so many different pieces of the puzzle of what's happening in both public and private markets. It's hard not to think about the macro as it relates to everything else in both public and private markets. How do you think investors should be thinking about what might happen from a macro perspective, and then how they should actually play the game on the field?
Well, take the Fed's dual mandate just as one example. You have inflation and you have labor. And you look at the labor market, there are signs of the labor market stabilizing, but you still have seen what had been a low fire, low hire environment at a time where you see AI accounting for almost a quarter of GDP last year. And so if you have that divergence forming, then really you have to keep a close eye on what the new normal is in the labor market as well. The fact that trend job growth can be well under 100,000 jobs per month when you look at the non-farm payrolls print. Or when you look at inflation, the other side of the Fed's dual mandate, you have a whole investor base banking on successive rate cuts throughout the course of this year. We've been saying we don't really expect that for the first half of this year. And to the extent that you get rate cuts in the second half of the year, then you really have to watch that inflation trajectory, because while we believe you could see the Fed really experience a path closer to target, that 2% target, it's unclear that it will get there as fast as Fed officials would like, particularly through the end of this year, especially when you have a first half of this year that still has fiscal impulse, strong earnings, strong growth underpinning the broader economy.
How do you think investors should play that if rate cuts are a little bit uncertain?
This is the thing. When you look at the public markets throughout the course of last year, you did see rate cuts, the prospect of rate cuts being a big driver into what a lot of investors were calling the broadening trade. We didn't love that terminology at the time because really you didn't see a broader buying of the S&P 500. You still saw a lot of concentration in the big names in the public markets. Finally, in 2026, you are seeing a truer broadening than what you saw from what was previously more so a rate-driven trade into small caps. But now that you have some stronger macro forces, right? You have growth remaining resilient, you have the labor market potentially stabilizing here. Early data in 2026 looks trending toward that direction. The Federal Reserve itself has said as much. So if you have stronger growth underpinning the markets and you're stuck with what is now still a K-shaped economy, can you see elements of that K-shaped economy improving, supporting the consumer, allowing for investors to really access more real economy investments? And that applies to both the public markets and the private markets.
I think that's such a great illumination of some of the trends that are happening in both public and private. So public markets, you mentioned concentration, right? That's been the that's been the defining feature of public markets: concentration, indexation,
10
correlation,
companies.
right?
10 companies
Like
accounting for almost 40% of the
40%.
S&P 500.
So you have that, but then you said something else that's really interesting, and I think was cornerstone to one of your themes in the 2026 outlook, which was divergence. And we could talk about that both in public and private context as it relates to maybe a trade away from large caps to small caps. Mid-market private equity is one example in private markets. How do you think about this balancing of concentration and scale and divergence in both public and private markets?
A few things. When we think about the divergences forming and the concentration that exists, the number one theme I would say in my travels, talking to RIAs and other wealth managers, is diversification. How do I get my clients diversification after we've seen 3 years of stellar equity market performance? So investors looking to take some profits, maybe rotate into other areas, both in their equity and their fixed income buckets. So let's take a look at what that looks like in private markets also. If you are moving some of that equity bucket over, then you might be looking at more growthy type areas, places that could benefit from the AI theme, specific places in growth equity, some venture capital. You take a look at what's happening in the fixed income bucket though, and you still see considerable volatility in the bond market. The fact that you still have had kind of stickier, generally speaking, longer term rates have had a lot of people rethinking, well, okay, where is my income coming from? Is that private credit? Is it infrastructure that does really well in moderate to high income environments? You're nodding, so I'm sure that you're relating to this. Yeah. And so you do see people starting to get more comfortable with private markets for investors that have not accessed them before, because they are looking for that specific return profile that they know that they can access and are looking to now move away from public markets that are experiencing volatility to do so.
I was nodding as you talk about infrastructure because that does seem to be an area where a lot of advisors and investors are really interested in, and now infrastructure has proven in a high inflation environment that it still can perform. So I want to relate that to kind of where rates may be or may go, and how you think about rates as it relates to private markets, particularly in fixed income or credit. So how do you think about what might happen to rates, and then how might that cascade to how investors might think about areas of asset allocation like private credit or infrastructure?
Right now, the base case, if you look at the market, it has been whipsawing in terms of how many rate cuts are expected toward the end of this year. And again, we relate that back to inflation. So when you look at the tail end of this year, between 1 and 3 cuts really is kind of the range of outcomes you can get. Generally speaking, what you can end up is an environment that's somewhat higher for longer. In that kind of environment, private credit is a really interesting conversation because of the floating rate dynamic of it. At the same time, because we're seeing a healthy backdrop in the economy, you're actually looking at a pretty healthy backdrop for those underlying portfolio companies by and large, notwithstanding some of the potential disruption we might see from AI, which we could talk about. Now, when we think about the opportunity in that higher rate environment, infrastructure is certainly one of them, but also what else will benefit from the type of inflationary environment that we're experiencing. I think that's what you have to think about at the end of the day, because we're not watching price pressures across the entire economy take off. We're watching pretty specific buckets, such as areas and services. Even if shelter costs taper over, will housing costs follow? What does that mean for private investment in some of these areas where still prices look like they are firm, but there are places that the private market can enter? Let's take infrastructure for just one example of this. The example I give on the road is you have the One Big Beautiful Bill. But the One Big Beautiful Bill has shifted a lot of social responsibility to the states. When we talk about infrastructure, the hot topic, as you know, is digital infrastructure. But what about regular way infrastructure, roads, bridges, airports? The fact that you don't have the ability for the government to step up as much because of the fiscal impulse we've already seen, it really does leave a large space for private markets to step in from an investment point of view.
I want to talk about another dimension of rate cuts or rate hikes that you covered in the outlook as well, the concept of good cuts versus bad cuts. I'd love for you to explain that a bit further.
This is so important because if we see a series of cuts in 2026, why are we seeing them? If we see them because of the disinflation process working its way through, that is a healthier set of interest rate cuts. if we see those cuts because the labor market is deteriorating faster than expected, bad cuts, right? These are bad cuts. And it's because we are seeing the macro starting to turn in a way that all of a sudden you start to get more concerned about areas like consumer spending once again, loans tied to certain portions of the economy. Whereas right now, because the labor market's stabilizing and because consumer strength has been resilient, you can see areas like financials, which is one of our big themes for the year, holding up quite well because the macro has held up. But the bad cuts, if we see the labor market deteriorating and we get more interest rate cuts on the heels of that, is not a great scenario.
I think that's a great segue to another concept that you laid out in the Outlook, which I thought was both interesting and instructive, which is the concept of blind spots. What are some of the blind spots that people should be looking for around the corner?
Among the biggest that we targeted, and we started really talking about this a bit around October of last year, when we saw the big hyperscalers starting to look to debt markets to finance the AI build out. Then you fast forward to early 2026 and you see the dollars just starting to mount. But on top of those dollars, the investor psychology is also changing too. All of a sudden, you saw some of the same winners early last year not being as rewarded by the market for the sake of spending. They want to see that ROI, and it's going to take a minute to see how that ROI plays out across this investment spend. So that's a blind spot. Of course it's a blind spot. What happens if tech leadership in the public market not only changes, what happens if the group starts to lag more meaningfully at a time where, as we've been saying, there's been very meaningful concentration risk in the broader market?
What should investors be looking for as it relates to CapEx and CapEx spend?
A few things. One is definitely the ROI, and we've seen examples of that where we see some companies saying they're spending more and more, but investors have been very willing to give certain companies more dollars because they're starting to see the payoff. They're starting to see it very specifically across their clients. Even more so, they're starting to see the competitive dynamics play out. I think competition matters in this space. When you start to take on debt, what it means is, well, okay, if I'm going to tap investors today for a set of dollars, and then a year, 2 years from now, I need to tap investors again for another set of dollars to compete even more ferociously against my rivals. Will that money be there as freely as it was today? Will the cost of financing go up? Will my financial flexibility be compromised? Are the dollars I'm bringing in keeping me competitive enough to keep investing? Because the story is going to take a while to play out.
I think that brings up another interesting thought around AI, which you mentioned earlier. I'd love to unpack the AI theme more broadly in a slightly more nuanced way, which is there are a number of different ways that investors can think about gaining exposure to AI in both public and private markets. Based on what we just talked about around CapEx, around concentration, particularly in the Mag 7, where there's a lot of exposure to AI, how do you think investors can think about having different types of exposure to the AI megatrend, but maybe not just in one way?
There's a few ways. And there are some ways that, as we were talking about, are more growthy versus income oriented. On the income side, we got a lot of questions about data center investing at this juncture. And what we say is that the landscape is very diverse. There's almost no fund created equal on this one. And you have to really look at the types of risks you're exposing yourself to. Is it the project itself? Is it the hyperscaler that you're attached to? Is it the energy and the cost of resources around that project? Is it the municipality you're building the data center in that might not want it in their backyard? What is it exactly that you're investing in? You have to understand, because you might be in this investment for a very long time. Now, the other part of it is that you look at the venture space, which is the growthier space, and the divergence between what you see in earlier stage rounds and later stage rounds in terms of the premium paid is stunning. And so realistically speaking, you will be able to potentially benefit if you get in earlier, but it's a much harder space to access. As you know, the dispersion is large, and if you get it wrong, it's much more damaging than other parts of private markets, rather, because you could be negative on that fund return. But on this one, we think it's really worth doing the work because of how many companies are private, how many areas AI is touching, and the next set of companies and industries that are going to benefit from the AI trade-offs we're seeing today. So we're seeing that play off in public markets and software this year. But really, you could really ask that of every industry. And so when we're looking at venture capital, we're looking to see what managers are doing that math behind how AI is going to play out in the longer term, especially given that the top 5 companies in private markets today are larger than the energy sector of the S&P 500. They're more than $2 trillion for just those biggest companies alone. And as you've seen, many of them have already increased their valuations this year alone. But again, if you're looking from a return perspective, getting in a little earlier, the only way you're really going to do that today is venture. But pretty soon, you're going to look at the market structure change to have more investors access pre-IPO stocks. It's amazing how many of those options are open today for people who wanted to get into the Anthropics and SpaceXs of the world, because now there are a lot of individual investors who have been able to get into fund form.
You bring up something interesting in that commentary around dispersion of returns, and manager selection matters in pretty much every asset class, but certainly even more so with interquartile spreads between first and fourth quartile in areas like venture growth, even private equity, as massive spreads depending on which managers you pick. I think that's a great segue to how investors should be thinking about this. So what? You laid out a ton of really interesting perspectives on the macro, blind spots, risks, different ways to think about this. What's the so what for CIOs and asset allocators? How should they be thinking about where this year might make sense to allocate capital based on some of the macro themes and trends?
So what's interesting about this year is in the public markets alone, you have seen valuations, broadly speaking, just kind of take a step back from a little bit from where you saw last year. That creates some really interesting dynamics, because on one hand, it means that there could be really compelling opportunities still from, a buy low, sell higher perspective. But when you look at private markets, we think that there are going to be really interesting opportunities. But what's going to impact investor sentiment this year is how we see these pipelines of exits start to materialize. Now, what's been fascinating is that over the last several months, you actually have seen bouts of volatility and the capital markets still be really receptive to all sorts of companies, private equity-backed companies and otherwise, venture-backed companies, AI companies, not AI companies. But can that continue? That's a pretty critical thing to consider this year, because it does underpin a lot of what we're seeing in private markets in certain areas of them. Now, again, income really has been a more popular part of the story, which brings you back to private credit and it brings you back to infrastructure. And so we would say that, do the math. Do the homework. Look, measure twice, cut once, and you'll see that there's a lot of noise, a lot of headlines, and frankly, a lot of fear that you can look through. One thing I think is really interesting right now in client discussions is to hear how many people are asking about how to actually access software today, despite what you're hearing in all the headlines. And it's a really lovely conversation to have, because what it shows me is that there's a large range of CIOs out there saying, okay, what is noise? What is reality? How do I invest today so that I can get in at entry points, whether it's in public or private markets, that can help see through that noise?
How are a lot of these CIOs and investors thinking about accessing software? Is it through private equity, venture, or is it through private credit? A lot of private credit has exposure to software as well.
Yeah, it's a little bit of both, definitely. But we also are looking at a lot of people look to structured investments to cap their downside, but it still experience the upside, whether that's single names or larger indices. And so you do see that with software, but also hardware. As we've seen still a love of hardware existing, but also internationally as well. And we wouldn't count out that part of the opportunity here, areas like Japan and Korea, where there's a lot of companies that could benefit from a lot of these global tailwinds.
So I want to close out before we get to the Q&A with just some of your perspectives and thoughts for everybody who's listening. You see things from 40,000 feet. What advice would you give to everybody?
A lot of people missed out on last year's rally. To me, that shows that a lot of people have been looking at the headlines and stepping back from the investment opportunities. And again, fear alone should not be a reason to not invest. And so I do think that because it's been a one-way market for the last few years, this is the time. You have stocks and bonds correlated in a way that they hadn't been for much of the last decade, really. And so the time to look at diversification options is now, because if you're in a 60-40, you're kind of in a tough spot.
I think that's a great segue. The time is now for Q&A. So we'll get to that in 1 second here. So I want to get some questions from the audience. We'll start with private credit. Private credit has been featured in recent headlines. How should wealth managers distinguish real risks from noise when discussing private credit with clients? And where is the opportunity in private credit?
So there's a few things. You were talking about manager selection before. That's of course true in areas where there's a lot of dispersion like venture capital, but it's also true for private credit, where when people were underwriting, when rates were zero and the environment was very benign and we didn't see divergences as drastic as they are today, underwriting looked a lot different. And so when we look at managers today, scale matters, track record matters, the ability to have seen the economy through cycles matter. And we also believe that we're at a moment in the private markets where there's more transparency than there ever was before. Ask your managers what's in their portfolio. They will answer it for you. And so this is an important element of what we're seeing right now, because when you look at the broader trends in the data, you actually see a lot of promising trends like coverage ratios improving. Companies that have private credit tied to private equity companies, you might have seen the statistic, have been actually doing better than the ones that aren't in terms of default rates. So that shows you that when there is a sponsor-backed loan, there's an element of control here, an element of these larger managers able to control the fate of these companies and really make changes earlier in the company's horizon to avoid some of those fates that you might see in software or otherwise.
One quick follow-up on that. Are investors thinking about how they might have exposure to a certain sector or industry across both equity and credit as you're talking to them in their travels?
All the time. I think one of the biggest points of confusion is that, oh, well, I invest in a private equity fund or a private credit fund and I'm diversifying. And then they notice that their diversification might be so similar to what they're already holding. And so, yeah, we are definitely seeing CIOs take a much more total portfolio approach. Those are the three words, I suppose, that have been really defining of the last, let's say, 18 months or so. As people really look to shift their allocations, like, okay, what am I actually accomplishing here? Outcomes oriented investing, which will bring you to the conversation of where am I in terms of industries, where am I in terms of size of companies that I'm investing in? Do I want my small cap exposure through an index that's publicly traded, or do I want to buy it in a secondaries portfolio, actually? And so there are a lot of ways to get similar exposures, and that now I think is the lovely part of this conversation where it's getting more nuanced. There are options. We can look beyond the valuations in public markets and try to get into areas where maybe you're just investing in companies at a better valuation with a longer time horizon, and then from there you figure out the liquidity constraints.
Well, purchase price does matter.
Yes.
So whether it's in equity and the various stripes of private equity,
or
venture,
debt.
growth.
Credit spreads this year are ultra tight. And so that is part of purchase price.
Yep, for sure. So I want to go to infrastructure and we'll dive a little bit deeper into that because there's a question from the audience on private infrastructure. So it's obviously been positioned as a long-term defensive allocation. What role does it play in client portfolios today? And what risks should wealth managers be thinking about as they're looking at infrastructure?
Yeah, we talked about some of them asking about, okay, is energy secured? I think that's one of the bigger questions that we get. I think also one of the opportunities that are probably understated in this area is not just data center investing, for example, in the US, but the green space that exists internationally as well. And the fact that you do have other governments around the world that are very willing to embrace these build outs and also looking to potentially embrace these build outs in a way that from a national security perspective, you can get more comfort in investing in these projects. And so what I'm saying is there's white space. Even if you see all these headlines around all the investment in the United States, there are areas that are still very attractive. The risks, we talked about energy, again, location also still matters. Concentration also matters too. Are you tied to just one company at the end of the day? Or are you tied to a basket of companies that will make this exposure be more diversified? And also manager selection. Do they have the resources and tools to navigate what is otherwise a very complex investment? And so where does it fit into portfolios? Is it defensive? It depends on the actual range of investments that you're accessing, which is why we say, look for the details. Ask about the details. They're really interesting. It's a generational change. But again, it doesn't, like any investment, it doesn't come without risks. It's not a riskless proposition.
So there is something else that's on the mind of investors, and the next question relates to that, as it seems. So tax efficiency. That remains top of mind for many high net worth investors. How are private markets solutions being used today to improve tax outcomes?
I'm glad you asked about this because this is definitely something that has come up in almost every RIA conversation I've had in 2026 so far. And it's because you've seen that run up in capital markets, and you've also seen a lot of people sell companies. This year and recent years, what they're looking to do is offset their capital gains. After such a run up, if you're selling equities this year, how is there a part of my portfolio that can offset some of that? Tax loss harvesting strategies tend to be one way this is reflected. Hedge fund strategies often that have a tax loss harvesting component have become very, very popular. And so certainly we're getting a lot more questions about that given the dynamics in the market.
So last word, what are you most excited about in 2026?
I'm excited that the market has been exhibiting a true broadening. The fact that investors don't look at the market, public or private, and say there's only one game in town and that's AI. The fact that people are looking for investment opportunities that can grow with the economy, whether that's real economy or AI adjacent that is just margin improvement. But realistically speaking, it's an investor's job to look for the opportunities for tomorrow, right? And so long as the fear of the AI trade doesn't keep people out, then keep an eye on the broader trends, the macro, and you'll see that a lot of things in the last couple of years have been left behind in the market as we've seen the concentration risks rise.
I think that's a great way to put a wrap on your first market outlook at iCapital. Congratulations.
Yep. Thank you so much.
Thanks so much, Sonali, for a great conversation today. And thanks everyone for your questions. If you'd like to continue the conversation or have any follow-up questions about today's discussion, please reach out to your iCapital representative. You can also find the full 2026 market outlook on the iCapital website.